Hello, Wildcats. I am here today to give you a requested video, a response to the question, what dividend stocks should I buy in 2022? Now, obviously, I'm a bit late for this, half a year late, actually. But the good news is that we're near a bottom, hopefully, in this market. At least what we can say is that a lot of stocks are at bargain prices relative to where they were earlier in the year. So this is probably good timing if you want to buy some dividend stocks, and if you just want the too long didn't read version, here are the three stocks that I am recommending, and I'll go through the details in a minute. But let me just say that this was supposed to be a top five dividend stock video, but I found that objectively my top five dividend stocks had two overlapping categories. That is, two of them were in the oil industry, and two of them were closed-end funds for debt, for income. So here they are, just quickly. There's Vicky Properties, which is a real estate stock. It's REIT, a REIT. And what that kind of stock does is it essentially invests in a bunch of real estate and redistributes the rent and whatever other income they have back to shareholders. We have EDP, Enterprise Products Partners, which is a oil and gas company. When you buy this thing, actually, you don't actually call it a stock. You buy units of it, but it's the same thing, essentially. And last, we have this Aberdeen Global Income Fund, where you're essentially buying debt and getting very high dividends from holding that stock. So, or fund in this case. So you can see the dividends here go from 5% to 14%. And usually, in a lot of cases, the higher the dividend, the higher the risk you have. And we'll see that when we talk about FCO specifically. So let's get into this. Just for my own convenience, I put everything in a little Word document. Might seem a bit boring, but let me just go over the details, and you can decide whether these are for you or not. So first we have Vicky. And what's good about Vicky is that it's going to be included in the S&P 500 index in the coming weeks. And statistically, once a stock is placed in the S&P 500, the stock tends to do very well afterward. The reason that happens is because if you have an ETF and you're mimicking the S&P 500, such as the SPY or one of the various mutual funds that track the general market, you're going to be forced to buy Vicky, because if you're going to track the S&P 500 and Vicky has been added to the S&P 500, you're going to have to dump those stocks that were rotated out of the S&P 500 and buy Vicky instead. So what's going to happen is you're going to see a bunch of buying pressure for Vicky, and that's going to naturally push the stock price up. Now, in terms of the actual fundamentals of this company, you can look into it. Analyzing a REIT is quite different from analyzing a normal company. You're going to look at different metrics. So one of the most important metrics here is the adjusted funds from operations, AFFO for short. And you're going to look at those trends instead of things like earnings or revenue. And you're going to see for Vicky, it's looking pretty good. You could say that's probably obvious if it's going to be included in the S&P 500. It's growing. Vicky, as for what it does, it's a REIT, of course, but it focuses on buying property in Las Vegas, specifically the Las Vegas Strip. And it recently acquired MGP, so now it pretty much owns the Las Vegas Strip. Not all of it, but a significant portion of it. So if you want to invest in Las Vegas and Las Vegas tourism, Vicky is pretty much your go-to choice. And the timing is good because we have tourists returning to Las Vegas. Finally, everything's opening up. So if you want to see the fruits of that phenomenon, Vicky's probably a good place to park your money. The average dividend increase for Vicky is 10%, which means that if you extrapolate this dividend increase versus the amount of money you're putting in for the investment now, what you're going to see in 25 years is you're going to be making 50% of your current investment in ROI every year. That is, the dividend is going to be paying you back half of what you paid for this stock now every year in 25 years. And of course, before you even get to 25 years, if this dividend increase of 10% continues up to 25 years, you will have for certain made all of that investment back just through dividends. Now, out of the three that we are looking at today, this is the lowest dividend, but it's probably the best choice in terms of timing because of the S&P 500 inclusion and because of Las Vegas reopening. It's also probably the safest of the three if you're a conservative investor. All right, moving on to EPD. This is in the oil and gas sector. So as we all know, the price of oil has been skyrocketing, and it's a pretty good place to park your money in the inflationary environment. Usually commodities do pretty well in inflationary environments, so you got this as a pretty good dividend stock choice. So the thing is, once you have an oil company that is facing inflation, the oil itself is a good anti-inflation asset, but investing in your company isn't, because the price of labor, the price of parts, the price of renewing and fixing and repairing is all going to go up. So we're not going to see EDP or EPD investing in its company and trying to reinvest its earnings. At this point, they're probably going to wait until inflation reverses or at least slows down. So at this point, what's going to happen is probably whatever leftover extra money EPD has is going to go back to the investors via dividend increases or via stock buybacks. Now, at this point, EPD isn't very attractive to a lot of investors because of its debt. But here's the debt, by the way. Debt is the red, equity is a blue. So the company has more debt than equity. However, it's about 1-to-1, and the company is not at risk of going bankrupt at this point. The important thing to note here is that when inflation increases, debtors essentially get more money, and creditors lose money. That's because you took out debt at a low interest rate, and now interest rates are higher. So you essentially kind of performed arbitrage, even if you didn't actually predict that inflation would be going up. I'd say that this is the safest pick of the three. I just said that about Vicky, didn't I? Well, they're both safe, I would say. All right, in any case, that is our commodity choice. And then our last choice is a 14% dividend payer, which is extremely high, but don't get too excited yet. So it's a global income fund. It essentially invests in debt all around the world, and you get to own that debt, and you get money paid back to you. The payments go to the company and then are redistributed to the shareholders. So obviously, this has the highest dividend payout in terms of percentage of these three, but the main risk is the total returns falling faster than the dividend payments you receive. And what I mean by that is, just take a look at this chart. If you had invested anytime in the past year or so, you'd have seen that the value of your investment has been going down, and the speed at which it's going down outpaces the 14% dividend payment you get. So even though you'd be getting a nice dividend during this time, your actual the worth of that actual holding has declined to where you have negative ROI. So what we want to do is avoid that situation. And the reason I'm recommending this at this point is that trends tend to reverse. So this downward trend will probably reverse. You see, we have kind of a inverse head and shoulders pattern right here. We have a support level at around 5.5. And I like to give a stock a very, very final chance at around the $5 point, because under $5, it technically becomes a penny stock, and I take all penny stocks off my analysis and watch lists. So this is like the final chance for FCO to give itself to redeem itself. Now, of course, that's kind of a risky assessment to just base it on technical analysis, but the technicals do look good if you're a fan of technical analysis. And of course, you're getting a 14% dividend, which is crazy good. So even if this trends sideways at this support level, you'll be profitable with this holding. And that's pretty much all I have to say. Oh, hold on, seasonality. Okay, so yeah. So like I was saying before, I had two choices for this debt fund, and I decided to go with FCO because I looked at seasonality, and I found that June is a really strong point to buy FCO at. If you buy in June, on average, and you only hold for June, you'd make 31% ROI overall, which is pretty good. So um, June is just a good time to buy. You got that little extra boost. You got the statistics on your side. So if you're interested in this stock, now is a good time to buy it. And that's pretty much it. If you have any questions, let me know in the comments section below. And if you have a request for the video, also let me know. That's it. Take care, Wildcats.